The broadcast is now starting. All attendees are in listen-only mode.
All right, hey there. Sorry about that. We had some technical difficulties. Go figure, even after we just practiced. So I appreciate you hanging in there for the Simple Numbers Cash Flow Model demo. My name is Mike Maxson. I'm the Director of Client Services, and with me is Michael Boggs, one of our senior consultants here. We usually have this fun joke we run through about this being the Mike and Mike show, Mike and Mike business show. We've tried to bring it to Greg a few times, and he shuts us down, but he's not here today, so we're totally going with it. So if any of you want to support us in it, please feel free. Write him an email, tell him how awesome the Mike and Mike show is. So let's get started here. We're going to go through a few slides. First, we're going to talk about what is the cash flow model. So the cash flow model is really the main financial analysis tool that we use here at Crabtree Rowenberger with our clients. Whenever we begin working with a new client, we immediately put their data in this model and show them their business as to how we see it and how it is presented here. I often joke that it's Greg's brain in an Excel spreadsheet. If you've ever heard him speak or read his book, you hear him talk about 10% pre-tax profit, core capital, salary cap, labor efficiency. These are just some of the things that encompass our model. And it's encompassing not only how it looks currently in the past, but forecasting forward with you in the future. The model provides a common language across businesses and across industries. If we put 100 business owners in a room right now and ask them all to take out their P&Ls, we'd get 100 different P&Ls, and you really couldn't have a reasonable conversation unless it was looking at the same industry. But in our model, we could actually sit all our clients down together, and they could have a legitimate, meaningful discussion about their business and how it relates to one another based on our modeling. Our model also allows you to have key numbers to make actionable decisions. I get calls on a regular basis from business owners from all over, and a lot of them are just pouring through their books. They're looking very granular, or they're looking over here, or they're looking over there, trying to just find something that can help them in their business. Greg never looks through our QuickBooks file. I don't even know if he has a login for it. He often just gets the model and reviews the model as it's sent to him after the month close. The reason being is because as we take you through this, you can see that we try to identify the key numbers based on our simple numbers philosophy that allow you to make the best decisions and pull whatever lever you need to in the business to correct it. So what's actually in the model? First of all, we start off with the dashboard where it's going to highlight key numbers. Initially, we always start off with rolling 12 profitability, direct and management labor efficiency, operating expenses as a percentage of sales, core capital target, or where you stand on your core capital currently, what's your salary cap. These are all just some of the basic ones, but as our clients work with us, they like to see different things. They might like to see how their marketing is doing as a percentage of sales, or maybe looking at some different analysis pieces of marketing. Or they might want to see the key numbers maybe broken down by a division or maybe by a certain group of clients. Then we'll shift over to the profit and loss, and we also have the forecasting that goes with that. And then we also have rolling analysis tabs, rolling 3, rolling 6, rolling 12. And we believe rolling analysis, especially on the rolling 12, is the best way to look at data, where one month falls off, another month is added. You're always looking at the last 12 months of data instead of just a rigid January to December time frame. We have our balance sheet, and then we have a simple numbers balance sheet, which is just a different take that Greg created of the balance sheet. We have your cash flow statement with a forecast. And then a lot of entrepreneurs, a lot of business owners are very visual people. So we put in graphs of labor efficiency, of profit, marketing, that allow you kind of see how the numbers are just moving over time. And then we have my favorite piece, which is the thinking model, where we're going to run through minimum target and stretch scenarios. And it also allows a portion of it where you can key in different numbers. So people who have the model maybe want to run through different scenarios with their management team or with their fellow shareholders to see kind of how things are playing out. So this allows them to play in there and see what the numbers are going to do based on maybe any strategic planning or anything they're looking to do in the future. I'm going to pass this over to Mike Boggs, but in the meantime, if you have any questions, make sure you just fill them out there on the side. We're going to have a question and answer portion at the end, but if you're typing them in on the side, we will read them off and get to them at the end.
So good afternoon. So I'm the greeny portion of the Mike and Mike Business Show. So as we go through this is a little bit more exciting, and Mike might provide some color commentary as we go through for some laughs. So, you know, what we're looking for on the cash flow model is to get to a true net income. We need the business to be reflective of what's actually happening, where we get to this number that we can actually make plans. Because ultimately that's what we're looking for out of the entire interaction is we want to establish a planned outcome. And some of the issues we have that can distort the data that may not be seen are some of these items like garbage in and garbage out. And what we're referring to is oftentimes we'll see in the books an entry that is not correct or that is missing pieces, or for example, the books have never been reconciled since the company started. And those are challenges that happen in the data, because the real reason for accounting is, yes, we have to file a tax return, but it's ultimately supposed to be analytical in nature. And the fact that we can look at the business overall over time and say what's really happening and how do we make decisions to either grow the business or maximize profitability or even make an impact in the community. And so as we go down the journey with every entrepreneur, we always want to start with where we're at in reality. And some of the pieces that are the biggest challenge are things like owner's compensation. There have been several companies I've worked with that are like, I'm 15, 20% profit. And, you know, from our perspective, we're cheering that on because we ultimately want to target 10% and better net income. But then we find out from the entrepreneur that they're not paying themselves. Well, we have a philosophy that everybody should be paid a market-based wage for what role they play within the company. And when we put that market-based wage in, then a lot of times they're down to 0% net income or even at a loss. And so that is a great place to start. It's very challenging from a reality perspective, but now we can plan the outcome and getting them to that market-based wage. Another thing that can happen on reality is dead bodies on the balance sheet. A common one is for anybody who deals with inventory, an inventory count never happens, so inventory never moves. Or you might have a bonus that you accrued, which means you expensed it but never paid it out, and that's sitting on the balance sheet. So, you know, these pieces that never move, we've got to find a way to filter them out to make sure that our P&L is correct. Ultimately, we know that if the balance sheet is right, then the profit and loss has to be right. There may be different categories, but in totality, it has to be correct. And the last piece is what most entrepreneurs are interested in, and that's how do I get to the point of distributions. Distributions is a common way to think about return on investment you make in your company. And everybody wants to get there where the company is now pushing money out beyond salary. And so we look at how do we get to that distribution, how do we create that planned outcome, and then how do we make sure the company is fully capitalized. And so that's what we're going to do. We're going to jump off the slides now, and we're actually going to get into the cash flow model itself. So one of the pieces that we look at as we go through this is I'm going to talk through some of these tabs, and then we'll actually get into just a small bit of financial analysis on our sample company here. But this is always our jumping point for each call. Entrepreneurs wanted a 10-second, hey, how's my business doing? And the red, yellow, and green creates that framework. The reason it can change for every company is we always set out the financial targets based on the customization of the industry. Every company is a little bit different. It doesn't matter if you're in lawn care, you're in manufacturing, you're a service-based business, your metrics may be, or your KPIs may be slightly different in all, but we know that we can set these parameters because we find the true KPIs that drive the business through the model. The next tab is the thinking model. We're actually going to do some number maneuvering on the thinking model today. And this is one where it allows us to plan the business. So if you want to grow to a $4 million company and you were 2.8, what's the pathway? What are the key triggers that I have to have? And then ultimately, what does that do to cash? As you know, and you'll probably hear me say more than once during this time frame, is the old adage, and since you're an EO, I know you've heard this, but that revenue is vanity, profit is sanity, and cash is king. And so we want to get to those last two parts as we look at distributions and as we look at capitalization within the company. So here's our 1 month profit and loss statement. You can see that it's significantly smaller than most companies because we're trying to simplify the data and present it in a way that we can make actual management decisions. And so when you look at this format, we get it down to essentially 9 to 12 categories, and we know the norms that we create for these categories, and we know when they're going off. But we think that 1 month is a very distortive look. And so we look at our first analytical piece on a rolling 3. And this is where each column represents a full 3 months of your profit and loss statement. So take this column you see here for December of 2015. That's got all the profit and loss data from October, November, and December of 2015, and helps get us that first launch look into analytical trending. And so I want to point out one piece that we notice immediately when I look at this. When you go all the way back to September, you can see a 92% gross margin, and now it's at 96%. So this is enough data for us to know that, hey, maybe we should dig into gross margin. What happened that month? Did our product mix change? Did you sell something that was more profitable? Did you have a better pricing from your vendor? And then you can start thinking strategic questions as in, is this the way we should operate going forward? Is this something that's sustainable over time? Because these are all things that make an impact as we look at overall profitability.
And to give you some perspective, how we use this here at Crabtree Rowan Burger, especially in the accounting world, is there is some slow times throughout the year. And so one of those times is usually the summertime, kind of coming off that April 15 tax deadline. You kind of have a little bit of a lull, people going on vacation, clients taking off, things that are going to happen during that time frame where it does slow down. And one of the things we've used the rolling 3 for within our business to analyze that time period over those 3 months and really try to improve that time frame, because you can really just spark a whole year worth of growth, especially in our firm and maybe in some other accounting firms as well, if you can really focus on that small period of time over the summer. So the rolling 3 analysis from our standpoint was very beneficial, continuing to analyze how the last 3 months from June, how the last 3 months from July, how the last 3 months from August, and are we continuing to improve that over time? So while some people could look at it and use it as a quarter, we actually look at it through kind of just that summer months and look to improve there, and what can we do to improve that number on the rolling 3.
Absolutely. So let's look at the rolling 12, and this is a little different look than you're going to see with a lot of those in our industry. And this is where each column represents a full 12 months of data. So in the column I've highlighted currently, you can see that that's January through December of 2015. But in the column just to the left, that is actually November of 15 through December of 14. And so what we're doing is we're smoothing out the anomalies and looking at the business over time. You know, there's a lot of accounting pieces that can go into the smoothing of data. The best example I can think of is accruing pieces. So you pay your general liability insurance for the company in January. Well, that insurance covers you all the way through December. Well, there's a lot of techniques you can use. You can put the bulk of that cost onto the balance sheet and expense it out month over month. But that doesn't really paint the true picture of the entrepreneur, because your pain point happened in January. You had to pay that cash out in January. Well, what the rolling 12 allows us to do is be able to recognize the smoothing effect of that 12 months of payment versus the pain of the 1 month cash plan that we have to do on a 1 month basis. And it reduces the amount of adjustments you have to constantly make and accounting processes within your books. Now, using the same analysis technique on gross margin we just discussed, we see that from this year to the last rolling 12, and when I say this year, December of 2015 versus December of 2014, you can see that there has been a 2% change in gross margin. And it goes back to those questions, is this a shift? Have we changed products? I just had a great call with a client earlier today, and we were looking at what drives his gross margin in his company. You know, his revenue was growing at a very high clip, around 30%, but his gross margin was only growing around a 10 to 15% clip. Well, this is a very different piece, and what we recognized is the primary driver of his gross margin was actually only growing very little this year. And so that was a great piece for him to go back and talk to the managers and the leaders within the company and say, well, you know, that revenue is vanity because gross margin's not growing. So those are all of those analytical pieces. So as we walk through the next tab, and we're going to come back to this because I want to talk about some of our concepts, we go to the balance sheet, and you can see that we simplify the balance sheet down to just a few categories also. And the reason we do this is we're using the balance sheet to predict cash, because ultimately that's where we want to be at the end of the day. You know, you can't go to Target and pay them with a percentage. You have to pay them with hard dollars. And so we want to make sure that the company has cash flow, and we use the balance sheet to predict that and to look at it over time. We also have the simple numbers balance sheet, which Mike referenced earlier, and this just gives you a different look. You know, one of the pieces we may want to look at is net working assets. Are they growing? How is all this playing into my equity growth? Is it declining or is it trending up? All these give us a different view of the balance sheet. The next statement is kind of our cash flow statement. Cash flow is one of those statements that is the probably overlooked and maybe the most misunderstood statement. And all cash flow tells us is, how did the balance sheet move and where did my cash go? So you have a conversation with an entrepreneur, you know, we do our monthly call. I made $100,000 this last month, but I only have $10,000 in the bank. Why? Well, we can look through the cash flow statement and see where the cash went for that month. The next few pieces are all those analytical visual pieces. So this is a marketing graph that we've created. We have some different terms where we look at revenue per marketing dollar spent. We like to look at gross margin, and this is where you take gross margin and you subtract marketing costs out of it, and you want to look at that and compare that to marketing spend. And what essentially that analysis does, it tells us for every marketing dollar we add, are we actually getting more gross margin dollars? If those two lines connect, then we know that adding a dollar of marketing dollar doesn't really add any value to the company. And so those can become great analysis tools. The rolling 12 graph. This is a really interesting look at this company. So if we take just a second here, you can see sales have continued to incline, but look what is happening to net income. Well, it's not really moving. Well, when you start to see the move, look what is happening to labor. Labor flatlines for a long period of time while revenue and ultimately gross margin continue to incline. So you can see that once all of these numbers pass, you can start to see the jump of net income. And it gives you that visual impact of seeing those numbers and saying, well, what happened to me? How did I get to be this profitable? Well, this shows that by holding labor constant over time, we were able to produce enough contribution margin to be profitable. And it gives you that spread look. Going back to our rolling 12, I want to discuss one of the most the most talked about concepts that we have, and that's labor efficiency. The man who aims at nothing hits with amazing accuracy. And so what we can use direct labor for is to target how much production we have to have. You know, when you think about the philosophy that you have with an employee of, hey, you're a cost to the business. Well, that doesn't create ownership or motivate anybody to produce. But when I look and say, okay, you're a productive member and I can show you how much you produce for the company, that creates ownership in somebody's role. And so direct LER gives us that ratio that we want to look at. And it tells us how many dollars of gross margin did I get for every direct labor dollar I spent. Well, what this allows us to do is really measure the effectiveness. And so you actually get two key metrics out of this. You get one key metric of, when do I hire? How do I know when the time is right to hire? So going back to our firm, Mike mentioned some of our numbers. We know that during our busy season, we have to have a 2.25 LER, and during our slow season, we have to have a 1.8. Well, when you talk about that kind of number, if we get up to a 2.5, we know that everybody is burning very hot. Labor is being used, everybody's working a lot of hours. We may need to consider hiring. So it gives us that trigger to find what's going on and who we need to hire and what position. When you look at a decrease, let's say it dips down to a 1.5 in our slow season, that tells us that either there's not enough work or somebody is being a drag on the company. That means somebody is not actually performing at their level. And so that key metric really helps an entrepreneur target what they want to have. The second key target that we look at is actually management LER. And so this is the scalable portion of your profit and loss statement. So, you know, where's my leverage point? Where's my scalability? It should come primarily out of management labor. If you look, what we're measuring is how many dollars of contribution margin do I get per management labor dollar spent. Now, the targets can be different for every company, and as we look, that's one of the pieces we set up. But the management labor also tells us if we want to add management labor, what do we have to return? So let's go to the thinking model for just a minute here. And we say, well, I want to add $200,000 of net income down here. I want to add, $200,000 of management labor down here based on our actual numbers. What do I have to be able, in revenue, to be able to make that higher? And so if you look and we start projecting the numbers, you can see that if we want to add $200,000 and stay at the same profit level, we need a 6.95. Well, that tells me that I've got to have this much contribution margin ultimately to make that higher. You know, so this is a salary range for somebody who might be a CEO or a VP of sales. And so you make this higher. Well, if I've got to have $1.4 million of contribution margin, what does that mean when I look at how much revenue I have to hire that person? So we can go up here and say, okay, I've got to have, we'll do the numbers here, I have to have a total revenue addition of $1.9 million, so almost $2 million to stay at the same level as I was in this column. Well, that's a big difference. You may or may not be able to grow $2 million with a sales VP. And so that's what the thinking model does. It actually puts action in words. And you can actually plan out different levels of spend, return on investment. You know, this number changes if I get a higher LER. And so we can take this side of the model and actually plan out that planned outcome for the future. Then we actually take those numbers, put them into the forecast, and say, do we have enough cash? Because often you have the discussion of, I don't have enough cash to grow. Or maybe you don't want to invest that much money into growing and you'd rather have a return on investment. I have another client this year that has grown to the largest he's ever been. He's going to bring in $500,000 in net income. and that's $500 of cash that he's going to bring in. The discussion I had with him is, do you want to open another location and expand? And he said, no. I would rather start to take the return on investment and not reinvest that in my business and not grow. He was like, I'm happy with our lifestyle. I'm happy with the way things are going. Well, there's no right or wrong answer there, but that tells us how to plan and move into the future. Or he could have invested $250,000 to $400,000 of that money, and we could open a second location. And so those are all decisions we can make on the thinking model to really push forward to the future and make those plans to get that outcome we want. Now, let's go back to the presentation just for a minute, and I want to go through one slide and one other information that we kind of deal with. So one of the common terms you often hear as you look at financials or profit is EBITDA. And you're looking at earnings before interest, taxes, depreciation, all of these terms. Well, EBITDA is not a great term for an entrepreneur. It's weak in its terminology simply because those are all pieces that we have to plan for. If you have interest that you owe on a mortgage, you have a note payable, or you have a line of credit, you actually have to pay that out cash. And then we have to plan for taxes. Uncle Sam is a terrible lender, so we always want to have that side of taxes planned for. And so when we look at what we want to plan for, that's actually pre-tax profits. The reason we want to look at pre-tax profit is because we can link it directly to cash flow and how cash comes in and out of your business. And then we take taxes out of the equation and say, okay, now that we know what our pre-tax profit is, let's plan for the tax consequences from that profit in a separate discussion. And so we kind of remove those pieces out. The next term that we always want to look at is revenue. I mentioned earlier, revenue is vanity. The reason for that is because gross margin is actually the result of revenue. We have a $100 million business that we work with that is a supplier. Well, his gross margin is 15%, which means he's only a $15 million business. If he staffs and spends like he's a $100 million business, he's going to be bankrupt. If he spends and plans like he's a $15 million business, then everything is going to work out over time. He's going to be profitable. And so that's why we say gross margin is a better look at what is going on, part of your economic engine. But in gross margin, we don't include the labor. So notice earlier we talked about direct labor and cost of goods. We have cost of goods for us is non-labor cost of goods. And then we keep labor out, so we keep it as a productive piece. But really the best terminology on the profit and loss in our model is contribution margin. And this is gross margin minus direct labor. The reason it's so valuable is it's the actual planning tool that we use to say, how much money do I have to produce out of what we call the business engine, our revenue, gross margin, and contribution margin, to be able to cover my operating costs, that overhead section, and still be at a 10% net income. And so it allows us to have the most value in planning whether or not we want to make changes within the business. So this kind of gives us what we talk about in terminology, because we want to create that common language that Mike mentioned earlier, and so that you can talk to other entrepreneurs and all be on the same page, because ultimately we all want to get to that same place. That's a profitable business that gives us a return on investment. So I'm going to turn it back over to Mike for the next section of our discussion.
Yeah, great. So we're going to actually take some questions now. Got a couple in. One person asked, so each column on the rolling 12 is 12 months. And yes, that is correct. Each column is looking at the last 12 months of data. The next is gross margin without labor costs is still a good indicator for a professional services company.
Absolutely, because there are lines of business, even a professional services company, that you have to consider. So let's go back to us as an accounting firm. We're a professional services business. Well, every tax return that we file has a certain fee. If you authorize states that aren't here, then you have to pay a fee for that. So that's actually all coming out of revenue. So number one, it shows, or there's two things that come out. Number one, it shows waste inside the cost of goods. And number two, it can tell you if you introduce other product lines that are not professional services. We deal a lot with health and wellness companies. So let's take a doctor's office. Well, you know, they're professional services in general, but let's say they decide to sell vitamins that go with their company. Those vitamins have a hard cost, so we can examine the impact to the gross margin. So it still is a very good indicator, at least on the front end.
What if we put the labor that is part of the production and non-production out? What if we
scroll down a little bit if I have more? Okay, so I think what you're asking, and you can resubmit your question if I don't get this correct, but we're looking at production labor versus management labor. This is a great discussion to have. The productive part is anybody who is directly producing revenue versus a management labor is somebody that's more administrative in nature. So, for example, the CEO could be in productive labor, so direct labor. So in our scenario using the firm, Greg is actually in direct labor. And then you would have somebody, we have someone at our front desk who is our director of greeting. I think, did I get that title right?
Yes.
Okay. Director of greeting. And you know, she is a primary administrative person. She does call scheduling, she answers the phone, she does all the administrative tasks. So she's actually in management labor. So I think that's what you're asking, but if not, resubmit and I'll try again.
How do you account for foreign currency for the modeling?
Okay. We deal with a lot of Canadian companies. I've got clients in China. We've got some in the Middle East, South America, so all over the world. What we do is we isolate out the currency problems down into the other expense part. So if you look at what we plan for is, especially in Canada right now, the exchange rate has been extremely favorable to a Canadian company who's doing business in the United States. When they bring that back home, most of them have been getting extra 5 to 10% return in the company. Well, what we do is we isolate that into the bottom of the model. So then we look at only the operating net income of the business. And that keeps that piece separated out so we don't depend upon exchange rates for profitability.
Do you have an example of variance analysis specifically in COGS?
We could, a specific variance analysis. Well, we can break out COGS. I haven't done it in the model. I guess I can live if you want to hand me that note. I can do a variance analysis.
Yeah, sure.
So we can actually, one of the things that we pride ourselves on is doing things live here, so we're going to hope this doesn't go haywire on us because I haven't tried this. Let's see, do we have a pivot? Oh, we don't have a pivot table for me to break out. So generally speaking, what would happen is I could dig in on this 1 month and tell you what makes up this $7,947. I can give you a good example of a doctor that we worked with recently whose vaccine costs went up significantly. He was kind of unaware. His ordering team had not told him that that was going to happen. When we went in and I said, well, year over year, your percentage changed. Why did it change? And I show him the difference in variance of costs, then they were able to quickly identify that it was in the vaccine costs. I had another one in manufacturing, and his cost of goods went down by 10% 1 quarter versus the last year, and it was all in redos. And so when you found he was having to remanufacture a large amount of items, that variance stood out immediately.
Does your analysis drill down to the GL detail?
We can drill down to the GL detail. What we primarily are looking for is more of a management style. So we look at something if it changed significantly. So a great example is looking at the model right now, and you can see November and December facility costs changed from $9,000 to $20,000. Well, when that cost changed by that much, I would actually get into the logs and we would break out what specific expenses changed. And then if I have GL detail, we can actually give the specific spend items in that category.
Do you have an example of a break-even analysis, and can it be done by business sector?
Okay. So let's discuss the idea of break-even. When we look at break-even for us is 10% net income. And there's a lot of different reasons that come into that. So we're looking to produce that amount. If you have class data, we can do a break-even analysis and look at different classes. So let's say that you have a services business such as ours, so the accounting firm, we have 4 different departments here. We have consulting, tax, auditing, and outsourcing. We can actually break out the revenue and cost and labor in our system because we tag the data correctly to be able to show what is the contribution margin out of each segment and how does that play into the whole of the company. And then we use that to kind of produce a overall break even, or what is it worth being in business in a certain sector based on the contribution margin it produces.
How difficult is it to modify the format of the financials?
So if you're looking at your internal financials, so whether you're using QuickBooks or Xero or Sage, it's not very difficult. You can actually redo your numbering system that will allow you inside the profit and loss to be very similar to what ours is. We've done that for several clients just by modifying their chart of accounts.
And in our modeling, when we first engage with a client, we usually request the balance sheet and P&L by month. In Excel is great. If not, we got the converter to convert anything out of PDF. But what we do when we construct this model, no matter how we get the financials sent to us, we could have a chart of accounts that's just massive. We're actually going to go in when they're constructing the model and source code the chart of accounts into a pivot table, and that is what is then going to drive and push the numbers to what you see here. How is facilities, marketing, payroll, tax, and benefit, how all that gets coded and ends up displaying for you here. Just in case if that was part of the question also. How does the system account for burden rates and modeling?
Okay, so if you're discussing government contracting, we can look at how burden rates affect your billing. If you're discussing burden rates from a planning perspective, we simply move payroll, taxes, and benefits below the section, and we kind of manage that by a percentage basis. So when you look at burden rate, most of the time it has to do with how you're bidding out a job. And so if we plan the contribution margin correctly, then all the burden pieces that go with it, such as workman's comp, payroll, taxes, and benefits, all get managed to the correct profit percentage.
Along with consolidation, is there a deconciliation ability in your system?
Along with consolidation. If you're discussing breaking out specific entities, I've got one company that we break out 27 different segments of their business and have one giant consolidated profit and loss statement. So we're able to do an analysis of all 27 locations while keeping the integrity of the whole together.
Do you have an example of break-even analysis and can be done by business sector?
We looked at that.
We looked at that one already? I thought we didn't talk about it by business sector. Does any changes in QuickBooks automatically align with your system or manual? So what we do is when we work with our clients is when we build out that initial modeling, we then, once that session is complete, we then offer ongoing services. So if a client wants to work with us on a monthly basis, we have monthly and hybrid rhythms where the client's model is getting updated on a daily basis. So the financials are either sent to us or we log in, we pull them, and then we update the model on a monthly basis. And we also have packages where we're updating the model on a quarterly basis. But yes, this is where we plug in your financials and we actually update the model. It is not an automated system.
So,
how is this different than survivalware? That's
no. This right here. How would you show product R&D labor costs? So product R&D is, and he mentioned software, is a very difficult piece because we want to bring it to market. Once again, we come down and we isolate into the bottom of the model and actually create an R&D section because we want to look at the total amount of costs we have and versus when we launch a revenue to the market. One of the most challenging pieces for software developers that they get into is they never have a product that goes to market, or they're simply increasing the efficiency of their current product. So we always want to look at those on an isolated cost event, and we can kind of keep track of those either one of two ways, at the bottom of the model, or we can do a segment breakout analysis that discusses the value they're adding back.
Yeah, we don't know what survivalware is for that. How is it different than survivalware?
I'd like to see the difference between operating versus cash B&E. Does your system do that? Operating.
Break even.
Okay, so you're talking about accrual break even versus cash break even. Absolutely. So when you're looking at the balance sheet will tell us what the cash stands at. And actually the cash flow will tell us if we're breaking even on a cash basis each month. So if you look down here, you can see the net cash flows from each month as they go across time. And so as you look across time here, you can see different cash events and what's going on within the company. While the accrual side shows us break even as we're billing. So one of the biggest impacts that you have in that is accounts receivable. And so I may have jumped around too fast for your screen to refresh there, but I'm going to sit here for just a second. So as accounts receivable goes up, cash gets taken out of the business. And that's one part we're able to predict and really magnify. We have a specific piece down here. We don't have it calculated, but it's called ARDSO, accounts receivable days of sales outstanding. And this allows us to show the difference of when you collect cash and when you expect cash. And that allows us to show that break-even piece.
Is there a way to model a professional services contract based on various scenarios to capture performance KPIs?
So if we're looking at a professional services contract, you can simply you can take this thinking model and take our simple numbers approach and actually build in the various scenarios. So you could say, this is a $100,000 contract. What if I use mostly contractors? So we build contractors in the cost of goods. So I'm going to change my cost of good percentage, which should allow me to reduce the amount of labor dollars I spend, and that would give you the contribution margin per contract. And that allows you to show, and you would just do that over scenarios. You could do a scenario where you have more internal resources and less contractors, and all those pieces out in a thinking model basis to be able to show that breakout.
What if we put labor, that would hold that one. I think that's it. That's it. So right, those questions. See if we missed any.
Okay, I think we covered all the questions that have been submitted to us.
And so I just got a few questions here. There's a few common questions we typically get, especially me. I talk to several potential clients every month, and I usually get a good set of common questions that I typically get, and I'm going to just kind of run through them. And by the way, Boggs doesn't know these are coming, so you know, whoa him. Yeah, so Mike, one of the things I get is you know, my business is different. I mean, how can this help? I mean, I'm in a different industry. I mean, you've never seen anything like this. How can you help it?
Well, the good news is we've worked with a large amount of clients across the United States and throughout the world. So we've seen a large amount of businesses. But ultimately, every business is the same in the fact that you have to take in more money than you pay out to have a profit. And to do that, you need to have a plan and not just quote unquote wing it to see what happens. And so we can take the model and build it to your business specifications and build in all those scenarios, because part of our process that we go through on a planning session is I'm going to learn as much about your company as you're going to learn about what we're looking at in the financial model. And that allows us a good ground and a basis to have those robust discussions as we learn about each other.
So I have trouble understanding what is direct labor in my business. How would you guys go about determining that? When I look at my business, you know, I just feel like everyone's administrative labor.
So when you look at direct labor, I primarily we're going to ask two questions. Number one, do they directly impact revenue? So for example, in a software company, I saw somebody mention something about recurring revenue model. They probably have a support function, a consultant or some kind of engineer who's dealing with the customer. That's direct labor. But really, the primary question comes down to which number do they impact and where can I hold them accountable? Should I hold them accountable to gross margin, which is direct labor, or should I hold them accountable to contribution margin? So gross margin means that they have a direct impact on what cost of goods go into a scenario, while the management labor tend to hold to contribution margin. A great example is the sales staff. When you have a person who's selling an item, you not only want to have somebody who sells the best margin item, but also that you can efficiently do with your labor. Because it doesn't do any good if you sell a $100 item and the cost of goods on it is $10, so you get $90 of gross margin, but it costs you $50 to produce it. So you only get a net of $40 versus a $100 item that costs you $40 to produce it, but there's no labor in it at all, so you get $60 of contribution margin. So that's kind of how you look at a sales staff and say, you know, where do I want to hold somebody accountable? You know, where would I hold them accountable? And ultimately, you just take that question and extrapolate it out to all labor.
Which that was going to happen to be the question I asked next about sales labor. We'll just throw that.
Mike and Mike, great
yeah,
minds think alike right
there. Right. Of course, you're like 6'3" and trying to call yourself Greeny. So can the model help us better organize, you know, whether is it our accounting or our tracking? Because when you guys are talking about this model, I don't know if I track things right in my business. Can you guys help me to better track things and help me get an understanding of that?
And so one of the neat things that we find in the model is we'll find out if data is broken pretty quickly. And part of what we do is we'll go in and have the discussion with your internal bookkeeper, the CFO. You know, I often have that discussion with them, and a lot of them can see us as somebody who is, you know, potentially going to take their job. And my conversation with them is my job is to help your job be easier and to make you look like a rock star. So we can actually look at your data and through an understanding of your business, help you tag and get the analytical pieces you need and want out of your company.
So you mentioned, you know, hiring, and so I get the labor efficiency piece where, you know, if we're running hot on labor or we're running real low, but let's say we're just in pure growth mode. How do we go about looking to hire at that piece? Because this could get dangerous where we just hire way too fast or hire way too slow. We don't have the amount of people to service the clients.
Yeah, so that comes down to planning. So one of the things I've mentioned multiple times, and you may be tired of hearing, is we're looking for a planned outcome. And so when we hire, we do the same thing with the model and the forecast of saying, if we reach these targets, this is how much labor you're going to need. And what's beautiful about it is the labor dollar spend is not a respecter of persons. maybe the answer is to increase wages, give out a bonus because you're only going to run hot for a certain period of time, or maybe it's add body count by adding new employees. And we can plan for all that through the model and the forecasting, and you'll know pretty quickly if you're not hitting your targets and you've hired, then you either slow down hiring, or we need to consider, the ramifications and hopefully never get to the point where we have to let people go.
All right, well, that's it for our questions. Here's the information where you can find this presentation, www.simplenumbers.me/Mike, and you can check out the website, simplenumbers.me. Also, too, is you can find my email address on the website. It's back here on the slide. If you have any additional questions, feel free to email one of us. If this is something you're interested in and like to work with us, or maybe have us build out a model for your company, shoot me an email and we'll get on a call. Yeah, go ahead.
And I do want to take just a second and thank Robert for setting all this up. Robert's a great guy. I've enjoyed getting to know him over the last bit of time, so we appreciate you setting this up for us.
Yep, and sorry again about us being late. It is the Mike and Mike Business Show, not the Mike and Mike IT Show, and even though we practiced and tried, we still messed up GoToMeeting. So. All right, you all have a good one, and like I said, feel free to contact